What's going on, guys? Brian's here. Welcome back to my YouTube channel. Now this video is going to cover multiple topics that I've addressed in previous videos. I want to showcase to you guys how someone with a busy schedule such as myself likes to schedule my swing trades. This is the SPY, and as we can see, the market has had a decent gap up. We're going to take a look at a call diagonal spread on the SPX, as well as a call ratio spread on the SPY, an XSP broken wing butterfly. These are all live positions I currently have on. We're going to take a look at the gamma exposure profile for this week, which was based on last week Friday. So this is when this information was generated. As the market closed last week Friday, I actually opened the call diagonal spread and I opened up the call ratio spread for protection. And then I also just swung this trade here a couple days ago, leading into what I was expecting to be this gap up. Those of you that attended my gamma exposure workshop in person in New York City a couple weeks ago knows at this point how I like to interpret this gamma exposure profile. This is a 0 DTE profile for yesterday, and within one glance at this profile, I was able to tell where I thought the market was going to close relatively simply. The market did end up closing right in between those two strikes as expected. This trader, however, asked me to explain why I was looking to be long. For the most part, this was the first indication. You guys should know at this point, I'm the lead developer at Quant Trading App, and Quant Trading App was built on these buy and sell zones. These are weekly levels that are generated at the start of the week. They predate gamma exposure. They're not based on the options profile. So when they coincide with data from the gamma exposure profile, it just adds extra confluence. But for as long as I can remember, I've been keeping things simple when it comes to these trades. If I see these long, what some people call pin bars or long wicks or long hammer candles, anything like this in an area of confluence is generally going to sway my bias. I'm naturally a long bias type of trader when it comes to the SPX/SPY, but we had a key gamma exposure level right beneath the buy zone, which was 6,600 right here. This was this strong pin, and then you guys know I like to look for a spike in volume right whenever I see that candle. That means regardless of what's going on in the news, I don't really care that much about the headlines. It's important to know when they are, because these catalysts can contribute to whatever bias you have actually playing out. But for the most part, I'm not trying to interpret what's happening on a macroeconomic level. I'm not paying that much attention to the headlines, because if I hyper focus on what's supposed to be coming out and I see this, I'll ignore this. And I know this to be my edge. It has been working for me for as long as I can remember. These aggressive pin bar candles with a spike in volume usually leads to price moving in the direction in which you are thinking. But more importantly, it provides a safe area to risk off of, and you know where to place your stop loss. That means if I'm looking to get long anywhere in this area here, my stop loss is comfortably going to be beneath that level. In this case, it's going to be below a key gamma exposure level. It may be below the week low or so forth. Whatever is the most significant structural supports level, you can just put your stop loss below it. I generally won't take my stop loss just because price breaches the level. I will wait to see how a 15-minute candle closes to decide. As we can see, price can breach a level but then close right above it by the opening of the next 15-minute candle. Now let's go back in time for a second, take a look at my risk profile here. So I have one lot of this call diagonal trade. It expires tomorrow. Today's a Thursday. It expires tomorrow. That is the short strike, and this is the long strike. If you don't know what a call diagonal spread is, that's okay for now. It's more so about the concept of this video. I love these spreads because the one thing you guys can see right here is that there is no risk to the downside. That means regardless of how low the market went, let me just going to update these slices here. If the market was to be down 1%, what this is saying is I'll be up about $446 right now. If the market goes up 1%, I'll only be up $150. If the market stays where it is, this is my current P&L right now. This is live. The market is open, so these numbers will be fluctuating. But for the most part, that is a quick way to understand the profile. This cyan colored blue line back here is the profit and loss at expiration. So if by tomorrow the market is up 1%, my P&L should be up roughly around $2,000 on this position. However, as you guys can see here, if the market was to go past a certain level, this is where my P&L would actually start going red at expiration. This level right here, this is called the T+0 line. This is my P&L as I'm currently in the trade. So as we can see, if the market was to go up right now 1%, that's how the P&L will actually be down less than what it currently is. At expiration, the P&L will be up, but I'm not looking to hold this trade into tomorrow's close. I will more than likely close this trade at latest power hour tomorrow. As time passes by, your T plus 0 line will move and it will converge and become closer and closer to your P&L at expiration. That is a quick overview on how to interpret a risk profile. I love option strat, especially on this channel, whenever I'm demonstrating or educating traders on these types of profiles. It makes it easier to see. So you guys can see the reason I have no risk to the downside, first and foremost, is because I received a credit when I opened the trade. This is how much margin requirement is being used, which is also my max loss. If the market was to go up 3% or so, that's what you guys can see it would take for me to be in a max loss type of scenario. The max profit is this right here. That is at expiration. So this might be an easier graph for you guys to understand. This is the T plus 0 line. So as you guys can see, as time is passing by, notice how that line is converging into the P&L at expiration. So while you are in the trade, it operates differently based on certain parameters, like implied volatility can affect the trade right here. So as we see, as this shifts up and down, you guys can see how it is affecting my max profit. The thing that's important to take away with this trade is that there is no risk to the downside. That is step one. So why last week Friday, after the market closed, I decided to even open this trade. Let's take a look at where I'm targeting. 825 is essentially where I'm thinking the SPX was going to go. 6,800 is actually where I was targeting. So 800 is where I was thinking, but I decided to play it safe and went with 825. For context, this trade was open here. So this was Friday's close here. This is 825 for context. This is where the SPX currently is, and this is tomorrow's expiration. So this is essentially the max targets or maximum profits for this trade would be if the SPX is in this region into tomorrow's close. Now, as you mature as a trader, especially with someone that trades advanced, complex options spreads, you think first and foremost, or at least this has happened to me, you start to think first and foremost about safety, especially if I'm trying to size up. I have personal goals next year to actually start trading with the largest account in which I've traded with since 2022 or late 2021. That means for now, I am sizing down as I want to make sure I have my strategies nice and tight and neatly, and I'm thinking clearly, because the moment you start sizing up is when we start losing some sensibility with our decision making. As I opened this trade, I asked myself, if I was to have $25,000, $30,000 at risk, would I be comfortable with this trade? I knew it was not safe to just be long bias by Friday's close, but I did not want to ignore taking the risks at the markets going up. I needed a position that had no risk if the market went down, because if we take a look at the gamma exposure profile, this is what I was looking at here. So this is the SPY 3 minutes after the market closed last week, Friday. This is an aggregate of all the expirations for this week. So this is the Monday to the Friday expiration, which would be tomorrow. This is where the SPY was, and this is also the SPX weekly aggregate profile for the upcoming week. This is published and posted in the Quant Trading App Discord at certain intervals throughout the day, and a record is kept of this. So this is how I just scrolled back and I went to check as the market closed, because this is actually what I was looking at last week, Friday. Now, as we take a look at this here, it's relatively easy. Again, especially for those of you that attended my Gamma Exposure Workshop, I am planning on hosting another one sometime in Q1 next year. I was initially thinking February. I'm actually going to let you guys vote on when you think would be a good time, but it's looking like it may end up being in March, just because my calendar is already starting to fill up for February and possibly even January. There's a pilot in which I'm going to shoot. Outside of this, I'm a filmmaker, so I have a pilot to shoot, and I'm probably also going to end up shooting another short film. That aside, as I look at this profile, this is where the market is closing. I could not ignore what I see as an inverted Wi-Fi signal. You guys have heard me say this before. Whenever I see a Wi-Fi signal, say for example, if this is on the call side, if I see a spike here, then a spike here, and a spike going up like this, I call it an increasing, Wi-Fi signal, and that's generally an edge that I've seen, and then that the market likes to gravitate towards those high net gamma exposure strikes. If we are in a net positive gamma environments, the markets will tend to climb up those Wi-Fi signals. Same thing in reverse. We are in a net negative gamma environments. This was on Friday, and we can see that this spike here, it increases and it increases. So I could not ignore the fact that the market was probably going to go to 660. Below 660, I didn't really see much of a reason to think the market was going to hold below here. 650 was something that I was aware of, but that at this point, being over 20 points away, is too far for me to be thinking of as a target within a 1 week span. Now, it can happen, but I like to operate within the realm of what happens more times than not. So that is too rare of an occurrence to expect a 20-point drop in the SPY within a 5 to 7 DTE timeframe. So I expected this to be the lowest the market would want to go, and if it broke below it, I imagine it would just bounce back above this level. As a reminder, this is not hindsight. This is actually information that was presented to us at the close on Friday. That means before all of this price action, there was already some sort of an establishment of what to expect around 660. You guys can see, look at the price action around 660. Look at what happened as the market broke 670. There was a fast acceleration in price down to this key gamma exposure area. On top of that, there was confluence with the quant trading app buy zone. The quant trading app buy zone is generated on a Sunday evening. That means before the market opened this week, this information was presented to us. If I turn off all of my studies, this is a clear chart. This information is coming straight from the quant trading app studies. I'm just copying and pasting the code right into the Thinkorswim platform, and it is actually drawing all of the levels on the chart for me. So that means I already knew at last week's close 660 was likely to be possibly a target for shorts, but B, most likely to be a strong support level. The high net negative gamma strike tends to be a very strong support level. Those of you within Quant Trading app or took the Gamma Exposure Workshop know I refer to this as N1. N1 just means it is the highest net negative gamma strike. It is the number one highest. N2 would be the second highest. So this is N2, this is N3. So we have N1, 2, and 3. The market will tend to gravitate towards N1 in a net negative gamma environment, especially when you see this type of gamma exposure profile where it is increasing, but below it, it is not likely to continue to remain below that level, especially if implied volatility is decreasing. In QTA, you guys know I like to share my notes at the start of the week based on these gamma exposure levels. This was N1 also after the market opened on Monday. We were able to take a look at a update to the gamma exposure profile. It looked relatively the same. We had a lot of absolute gamma at that strike also. As we can see in the background here, there's a spike, and that's why I like to put that note that it was AG3. That means it was the third highest absolute gamma strike. I put this red rectangle around it to really highlight this is the strike that I would expect there to be some sort of major strong support. This is 1 hour into the market's open on Monday. 660 is N1, and I would expect it to be a very strong support. Again, before the market gets to 660, we can formulate a plan. That means for me, when the market gets to 660, I'm just going to wait to see what type of activity is happening. This is not a strong sign for me to be a buyer because we can see how aggressive that selling happens. It wasn't until the following day that I really become confident to get long. Now, getting long on this day for me is in position of something like the XSP. I'm looking to add a little bit more long delta to the portfolio. The XSP is a nice cheap way to do so, and as you guys can see, I'm targeting 670. So this is a broken wing butterfly. This is, again, this video, I'm showing you guys multiple things in one video. You more than likely need to check out some of my other videos and where I've covered these specific types of spreads and strategies. I wanted to showcase you guys how you can combine almost everything that I've discussed on this channel before. So this position was actually opened a couple days ago. This is as I started seeing signs of some life coming into the market here. There was a nice bounce. Market recovered the buy zone, and I liked that it was holding here, and we saw some strength coming in. So this is where I actually started opening this long position, targeting back up here. This is extra confirmation for me yesterday that things are working in my favor. This is showing that the buyers are aggressive at this level. There is interest at 660, but the advantage is, guys, before the market even opened this week, I was able to already foresee this and think of this as the type of activity that was going to happen here. If you're an athlete, one of the things they'll tell you is before competition, before game day, if you can visualize how you expect the game to work out, if you can think about your best plays, if you play, if you play American football, if you play basketball, even if you run track and fields, in your mind, you should be able to see yourself running around that track. If this is 400 meters, and you're starting here and you have to run around this entire track, you already know this is where all of that pain is going to start kicking in. So this is where you can start thinking about, this is where you need to lift your knees. This is where you need to train to get in better on. That first 100 meters, you know, is going to be relatively fast and smooth for yourself. This backstretch here, things are going to be flowing. Momentum is going to carry you. That real pain is going to start kicking in once you hit that first 200 meters. Then once you hit 300 meters, that significant pain comes in. This is how athletes are thinking about their competition or their event beforehand. They can visualize a lot. For me, it's the same thing as you're trading. It is close to a competitive sport as you're going up against everyone else in the world that is looking at the same chart as you, and anyone else trading the same SPY. There's someone on the opposite end of what you're thinking. So if you're looking to be, buying here, then someone is selling to you here. The person that is short selling to you here is actually the one that's taking a loss at the moment if you decide to realize the trade. So with there being an opposing force to your decision making, you should be able to visualize what you're going to do and how you're going to execute beforehand. That's one of the reasons why I like gamma exposure, because it can allow you to actually formulate a plan in your mind based on that profile. The tools within Quant Trading app were built to add confluence to these. If we head over now to the SPX, and let's take a look at the SPX's gamma profile at the end of last week here. Those of you that attended the gamma exposure workshop, for a second here, just pause the video and then go to your SPX chart, plot the levels on this chart like we did in person during the class, and then take a look at how price action played out this week. You guys will take notice of, look at what stands out right here. We have this positive gamma exposure island. That is down as 6,620. If we head to the SPX for this week, let's see where 6,620 is. Right here, right? You guys know how I think about these positive gamma exposure islands. That is before, that is before Monday's open. That was based on the data at Friday's close. We had the same information at Monday's open, but before the week even started, 620 should be a level that is marked off on your charts. Then those of you within Quant Trading app have the extra confirmation of the buy zone being there. So if I get a question like, why am I long biased? It's because of this information that is presented to us, as well as the edge. And then we get the confirmation in price action as well as volume. With the SPX being here on Friday, I'm looking, if I'm going to be long, this would be my target, 800, right? Massive absolute gamma. However, I'm seeing this as a potential really sticky level. So anywhere within this region, I don't like to get too picky when I'm making my targets. I'm not looking for perfection. The way in which I'm seeing is I just want to cast a net around this whole area, and I want to capture as much profit as possible. Obviously, if we close exactly where I would like, there's room for maximum profit there. But the way I see it is I'm just casting a net, and how wide of a net can I cast relative to how much I'm risking? This is way too much net negative gamma exposure for me to be entirely or foolishly bullish. Yes, I can have my bias that the market is going to go up, but I'm not going to ignore that it's probably going to go down first and then up. And I don't want to try to time everything perfectly. So that's why this is a profile that comes to mind. If the market goes down, whatever, who cares? I'm going to walk away with some sort of profit. If it does go down and then it bounces, okay, now we're talking. There's the opportunity here to make a lot of money. And obviously, if it goes exactly where I was thinking, we should be rewarded the most if you are about as close to perfect as you can be. Again, this would be perfection. The market actually closes here tomorrow up here, but constantly aiming for perfection is dangerous. Now, a strategy with this, say for example, if I'm in something like 5 lots, is going to be around $10,000. $10,000 is generally going to be the max for this type of swing trade that I'm going to trade. Next year, however, I am looking to increase my size much more than my usual 10 lots that I restrict for myself for these type of weekly swing trades whenever I do decide to run them. But this is where we have to think about safety. Obviously, there's way too much risk because no one knew. Let's just say some headlines came out over the week and the market was actually up 1% to start the week. If the market was already at this target by Monday, this position would have been in serious trouble, and that actually would not have been good for me. And I'm constantly thinking, what happens? What's the worst case scenario? What happens if something goes wrong? What happens if I'm just entirely wrong? And let's just say the market just blows past the level in which I'm thinking. You guys can see here, the break even for this is around a 1.9, about a 2% increase on the SPX. Again, that's at expiration, but the break even would actually be much lower at the time in which I would have opened the trade. So that means this is way too much risk. As a risk manager, as a portfolio manager, I have to then ask myself, is this position way too risky? And at that point, it was way too risky. And that's where I like call ratio spreads, because it allows you to structure profiles that can reduce your risk. This was the very first call ratio spread that I opened. This was on Friday. As you guys can see, just after I opened this, I immediately opened this call ratio spread. I always go longer dated than the main trade. So in this case, this was a 7 DTE trade. That means this needed to be past the expiration. So this trade right here, again, it expires on the 21st. The last strike is the 24th. I just went with the 25th. This allowed me to have some sort of protection over the weekend because it meant if the market was to gap up and go really far, I wasn't going to be in so much trouble. Now, as the markets came down to this level here, there was no need for that type of protection because as the market was down here, it's unlikely that it's going to gap up 3%. So the risk was removed. As the market comes down to the buy zone, I can remove that protection, but it does not mean I want to go completely unhedged. So I then have to ask myself, is this too risky to continue to hold? And yes, it is, because if the market was to bounce back up, you guys can see here, it will be in this valley, and this is not where I want price to be. So I actually closed that trade out, and that's when I opened up this one that morning. So this is the 18th here. This now means I have protection, the same protection to the upside, but I pushed out a little bit further in time. And this now means if the market was to gap up way past where I'm thinking, so if we take a look at the SPX here, if the market was to be up, we'll say 1.7% right now. If the market was up 1.7% right now, so around here, this position will be up around, we'll call it $1,000, whereas this position will be down about 450, call it $500. So it ends up being a net positive position, but you guys can see this valley right here is not as steep as the other one because there's more time on this. This is extremely advanced, by the way, call ratio spreads. I haven't done a dedicated video on call ratio spreads as well as put ratio spreads, but these ratio spreads is one of the ways that I can swing larger positions and protect myself. And that's one of the things, again, as you start scaling up and as you have more and more experience as a trader, you start thinking mostly about not only safety, but consistency. I'm not always looking for these big wins. I'm just looking for a system that can consistently churn out some sort of profit. This is a shorter dated swing trade for me as it was only a 7 DTE, so that's not very long, but I will often be in an 11, a 15, something like a 21 DTE. And then obviously, with the income spreads, they're going to be around 40 something DTE if I'm running some sort of iron condor. But I want it to be a little bit more aggressive this week, as it is also another part of my personal goals. I want to get back into more of the weekly options, which is where I think like most of us started out with the weekly options. Then I started pushing out further and further in time to get more safe to run bigger spreads. I started running things with $25,000, $30,000 in margin. But as you trade shorter DTE trades, your position size should be smaller. So my personal goal is I want to trade with the same size that I used to trade at these longer dated options within the weekly spreads. That means if I have $20,000 in risk in a 7 DTE, that is a lot for me currently with where I am in life right now. And I think for most traders, 20 something thousand dollars in a weekly options spread is a lot at risk. Now, with experience and knowing how to hedge these positions, it won't be that risky as I'm just managing the risk around the main position. So this is my main bias for the week. And if you ask me what my bias is, it's I'm, slightly bullish, but I can't ignore the fact that the market does not look very good right now. So I'm seeing and acknowledging the fact that it's probably going to go down. I want no risk to the downside. However, I know whenever the market hits these high net negative gamma strikes, if IV does not continue to increase, the market will more than likely have this sort of ripping, rallying type of effect into the end of the week as Vanna and Charm kicks in. So this type of structure allows that to happen. That's by taking one look at this type of gamma exposure profile from last week Friday, as well as this gamma exposure profile from last week Friday on the SPY and the SPX. I can then open this trade to swing it for the week, which covers most of the profile and still leaves me with the flexibility to have a home run style type of week. Then I'm hedging this and then adjusting the hedge once I see I no longer need this type of protection because the hedge now becomes too dangerous, and then reopening another one. Whereas you guys can see here, this is the T+0 line for this. So even as tomorrow is closed, let's just say the market stays right here, this hedge is not going to cost that much money. If the market does pin, say for example, around 670 and implied volatility spikes back up just a little bit, this trade will be down around $300. If we take a look at this, and let's just say tomorrow's close, the market does pull back a little bit, this trade will be up around 500 and change. So they might end up negating or canceling each other out, or I'll walk away with at least a couple $100 of a win for the week. Now, if I close this position out now, you guys can see it's a net positive of close to $500. $100, and that would have been the results from this type of campaign, as one trader might say, as this is the complete campaign here. This is the SPX, again, just one lot now at this point. And then if we were to go to the SPY, you guys can see it's just one lot of that ratio spread here. This is the P&L. Obviously, if the market was to continue to go up, then this ratio spread will end up turning out a really nice win. If the market went up tremendously or an unexpected amount over the next couple of days, there's room to make a lot with these type of ratio spreads. If the market was to pull back 1%, it's just going to eat into some of the profits for the week, but it is a way to position myself on my profile in a way that it's almost like I'm making it hard to actually lose money versus trying to make a lot of money. And that is also a little bit of a shift that comes with portfolio management and knowing when to trade defensively, knowing when to be aggressive, or when personal goals shift within the markets. To add a little extra P&L, that's where the XSP might come on the side. This is going to be like a 1 DTE, a 2 DTE type of trade, just looking to bring in some extra P&L that if the market does pin here, this is actually for today. I didn't bother to go with the Friday expiration just because this was more so around thinking if Nvidia's earnings report ended up causing the markets to break out, this is what could happen. And let's just say the market got stuck right around here for today. I didn't think it was going to be this aggressive, but that is the power of Nvidia. And again, I'm not looking for perfection. Obviously, if I was aiming for 750, this trade would probably up an extra 30 cents or so an extra $30 per lot. And with two lots, it means there's not much risk at play. When I shared a couple of these in the QTA Discord yesterday on the Option Spreads channel, the trader that asked, it might look a little risky, and that's what sparked me to decide to demonstrate that it's actually not that risky, especially when you know what you're doing. There isn't really that much risk. I don't look at a profile like this and see it as something that is risky. I am acknowledging the fact that if we do go too high, there is serious risk here. It is unlikely that the market was going to go to 6,900 this week. However, I'm asking myself, if I am wrong and the market does go to 6,900, what can I do to prevent a massive drawdown? So if the market did go to 6,900, there isn't much concern here because I structured a position that can equally make, or a lot more, that can make the same amount as the bigger position would be down to at least negate each other, or in this case here, it can actually walk out net positive. The valley at expiration is something that is ignored because this trade expires on the 28th of November. I will be out of this position by tomorrow, the latest. So what happens next week is of no concern to me. Obviously, if I jump forward to Monday of next week, you guys can see that the profile changes, but I'm not going to be swinging this position over the week. And I'm going to assess this. Let's just say this was a Wednesday expiration of next week as opposed to like a Friday, then I might have been adjusting this call ratio and saying it's too risky now because it's too close to expirations. If that was the scenario, then I would have just closed out the call ratio spread for today. Then I would have looked into something like a 10, 11, 12 DTE call ratio spread just to offer the protection for if the market was to break above this zone here, because this is where things get dangerous. That is portfolio management, that is risk management, and it's actually less about trading. A trader is probably looking at candlesticks and is looking at price action and is looking at all sorts of different confluences and so forth. Now, I am a trader, so I'm not ignoring those things, but when I'm getting into the weed of it, I'm actually looking at things more through the lens of a portfolio manager and a risk manager. That shift is something that comes with maturity. It is something that comes with when you are looking to increase your size, especially when you trade advanced or complex option strategies. You can do so many things. There's a million different ways to analyze the same information. I love gamma exposure because of the structure it can create. It allows me to get a forecast for what's likely to come. If you'd like more information on Quant Trading app, link is in the description. This weekly outlook is a tremendous edge for swing traders, as you can get some sort of an idea for sentiment for the upcoming week. You can pre-plan your levels and then confirm them on a Monday morning as the market actually opens. And specifically, if your schedule is way too busy to focus on the 0 DTE trades, you don't need to ignore the swing trades. Guys, I hope you enjoyed this video. It was an unconventional one, showcasing to you guys some of my actual trades that I actually ran this week, as well as walking you through the thought process and why I'm approaching the things in which I am approaching it. Again, this is for someone with a very busy schedule such as myself. I am an entrepreneur and I'm a filmmaker. I have my fingers in a lot of different things, a lot of different team meetings, location scouts, and I am a developer. So I'm coding at one point throughout the day. I'm having meetings at other points. I'm hopping on phone calls, and then I might be editing a film, having conversations with other producers, all the while trading, as well as administrative duties, as well as a million other things, not even including personal stuff. So even someone with about as unconventional and chaotic or busy schedule such as myself, you can still structure different swing trades for a week and still not have to miss out on everything that's happening, and just being able to check in to see how things are going. With an alert set at 6:20, it meant that's when I checked in to see, okay, do I need to make any type of adjustments to my risk profile? Wednesday after the morning session, as I was doing a location scout for a short film that I'm shooting potentially in December, it meant that I missed this morning session here, but later in the day, as I'm at my desk around this time and I'm posting, this type of stuff in QTA, this now starts confirming a little bit of the bias that I had early in the week. But even if I was not here, I would have had the alert again set at 6:20. I would have checked in later in the afternoon and I would have seen this type of price action and then check my risk profile and say, oh, okay, looks like things are working out the way in which I'm expected. I'm good to go. I can decide now if I want to grab a call or so. Now, I did take some scalps here and there, even on Tuesday when I was able to catch some of this price action here. This is from the attendees that attended the gamma exposure workshop. One of the traders inspired me just to get back into trading the futures again, specifically the micro contracts, as the risk is not that high with those. So a little 25-point bounce, the same thing. I was liking the wick stop was coming. We were below N1 and catching that scalp here. And at this point, the people that attended that gamma exposure workshop, I think, walked away with a very holistic approach to how to be prepared for the day. And this video specifically, I'm addressing to you guys, I'm showing you how you can also be prepared for the week. We didn't get that much into a weekly profile, but what we studied on the 0DT time frame applies also to the weekly approach. Guys, if you enjoyed this video, thanks for watching. Like the video, leave a comment if you learned something, subscribe to the YouTube channel if you're new here, and I'll catch you on the next one.